The traditional link between the US Treasury yields and the dollar has broken down, with higher yields now coinciding with a weaker dollar. This shift is driven by investor concerns about the US fiscal discipline and policy uncertainty. Historically, rising yields signaled confidence in the US economy, boosting the dollar as a safe haven. Now, policy volatility and the growing credit risks have disrupted that pattern, forcing the investors to rethink the hedging strategies and driving interest in alternatives like euro, yen, Swiss franc, and the gold. Hello everyone, welcome back to our channel and welcome back to this video. In this video, we wanted to share with you how the correlation is breaking between the dollar and the treasury yields, and hence we wanted to share with you when correlations break, the dollar's divergence from treasury yields and how it exposes deeper risks. For years, the US dollar and the treasury yields have moved in tandem, a relationship that has served as a key barometer for investors worldwide. Higher treasury yields have traditionally signaled confidence in the US economy's strength, attracting foreign capital and bolstering the dollar's value. But that relationship is now fracturing, revealing cracks in the foundations of America's financial markets. Recently, we have seen the treasury yield climbing from 4.16% to 5.42%, a move that would typically coincide with a stronger dollar. Instead, the dollar has dropped by 4.7% against a basket of currencies. According to Goldman Sachs, the correlation between the yields and the dollar has fallen to its lowest level in almost 3 years. Let's try and understand this disconnect. Under normal circumstances, rising yields would indicate a stronger US economy and attract inflows into the US assets, pushing the dollar higher. This time, however, the story is different. The yields are going up because US debt is more risky and due to the fiscal concerns and the policy uncertainty, and at the same time, the dollar is weakening. This dynamic is more commonly associated with emerging markets, and it has investors questioning the very foundations of US financial stability. The recent Moody's downgrade of the US credit rating has further highlighted concerns over the fiscal sustainability. Analysts show that the US credit default swap spread, essentially the market's price for insurance against a US government default, are now at levels comparable to those of Greece and Italy. Let's talk about what has led to the erosion of institutional credibility. The strength of the US dollar comes partly from institutional integrity, the rule of the law, independence of the central banking, and policy that's predictable. The last few months have called that integrity into question. Now, this erosion of trust is profound. When a country's currency functions as a global reserve, its stability is underpinned not just by economic fundamentals, but also by the confidence that its institutions are above political pressure. Investors are now forced to confront a reality in which that assumption no longer holds true. So what is the challenge for portfolios out here? The breakdown in the dollar yield correlation poses a new challenge for global investors seeking safe havens. And analysts are pointing out that this changes everything. In the last few years, having the dollar long in the portfolio was a very good stabilizing factor. If all of a sudden the dollar is correlated with risk, then it increases the risk. The divergence between the higher yields, a weaker dollar, and lower equity prices undermines both the common portfolio hedges investors have relied on for long. And this has prompted many to reassess their strategies. This brings us to a time wherein the hedging and diversification both are taking center stage. Investors holding the dollar-dominated assets have increasingly moved to hedge their positions, effectively selling the dollar to protect their portfolios. And if the dollar continues to weaken, especially against the euro, yen, Swiss franc, which have all appreciated recently, there is a recommendation to move towards those currencies and even have gold as an additional hedge. So the big picture out here is that the shift in the correlation between treasury yields and the dollar is more than a statistical anomaly. It reflects deeper market concerns about America's fiscal discipline and the integrity of its institutions. Investors are no longer buying the narrative of US exceptionalism unconditionally. Instead, they are demanding higher risk premiums and more robust hedging strategies to navigate an increasingly uncertain environment. And in the months ahead, the interplay between US policymaking and fiscal sustainability and Federal Reserve independence will remain critical in shaping the market behavior. For now, the dollar's safe haven status looks a little less certain than it once did. Now that's all that we wanted to share with you in this particular video. Hope you've enjoyed this video. Do stay tuned in for more. Thank you.